Hello everyone, this is Kelly Ann Worthington. I'm a loan officer with Liberty Home Mortgage, and today's topic for Mortgage Monday is student loans and how they affect your debt to income ratio, how they affect your credit, and how they affect you getting a mortgage. So with all Mortgage Mondays, I want to keep it short and sweet for you, just about 10 minutes to kind of go over things and tell you little things that I think people will find helpful. Today's topic of student loans, the reason why I wanted to cover it is because over the past few months, I've definitely had a lot of people asking me about their student loans and how it affects them, and what if they have no payment, or what if they make payments monthly. And so I thought this would be a helpful topic to cover with you, whether you're an agent and realtor and wanting to know how to talk to your potential clients about their student loan debt for getting a mortgage and what mortgage they can afford, or whether you be a client or a current customer or of mine, or someone looking to get a loan in the future. So two websites I want to talk about before I get into student loan debt information is annualcreditreport.com. That is the website you can go to get your free annual credit report of all three credit bureaus. So you have TransUnion, Equifax, and Experian. And annualcreditreport.com, you have the right to one free credit report a year that does not negatively affect your credit to get the report. So definitely check that out if you've never done it. Getting a credit report annually to know what's on your credit is super important. The second website is not free. It is a membership website. It is myfico, myfico.com. But for those of you who are wanting to keep an eye on your credit, build your credit, know monthly what your credit scores are, myfico.com is a great website to access that information. So again, annualcreditreport.com for that annual free report, and then myfico.com is a great website to check out if that's something you're interested in. But again, that one is not free. I believe it's around $20 a month or something like that. So student loans. When you come to someone like me, your loan officer, and you are wanting to get pre-approved for a loan, your student loan debt will be factored into that equation. The way we access that information is through your credit report. So when you get pre-approved for a loan, you will have one hard pull on your credit at the time of taking the application. The reason why I, as the lender, have to do that is because we have to be able to verify all of your liabilities, assets, inquiries, collections, etc., because that all factors in to your debt to income ratio, your risk level, and the amount that we can get you approved for with a loan. On that topic of your credit report, though, I think it's super important. One of the things a lot of people don't realize, and I think is very important to know, is that your student loan debt is looked at differently than your, say, car payment loan or your credit card. So where a credit card and a car payment are looked at as 100% debt for your debt to income ratio, a student loan isn't. So a student loan is actually only looked at as a much smaller portion, usually across the board around 1%, but I'll get into that in a little bit. So where you have a student loan debt calculation of only, say, around 1%, your car or your credit card counts as 100% debt. So when looking at things to pay off, to help build your credit, I'm not a credit advisor. I can't tell you exactly what to do, but the numbers show that your car loan, your credit cards, those are things you want to get paid down, especially credit cards. You want to keep your balance under around 20% because that helps build your credit, but also because things like your credit card and your car payment count as 100% debt, where your student loan debt is going to count much less against you. So if somebody's out there saying, well, you have to pay off all your student loans before you can get a mortgage, that's not accurate, because every single person's situation is different, and every single person's situation in regards to their other liabilities and their student loans is different. So it is not one size fits all, and that's where your loan officer, someone like me, can come in and really help you navigate your credit report, see what's affecting you, how, and help you figure out what to do to be able to get the best loan possible for the home that you're looking to purchase. So with that being said, the next thing I want to talk about is there are four main different categories of student loan payments. And they're all looked at a little bit differently. So your first one is your regular payment, right? So that is when you get the loan is started, and you have to make payments. It is what your regular payment is scheduled. So many of you are just out there making your payments scheduled of the loans that you took out for your student loans. Now, a lot of Americans have done what they call deferred loan programs. And so deferred loans are where you work out with your loan company that you want to defer your payments for a while. You know, for example, you're in college, you want to defer them for a few years outside of college until you have a job that allows you to make more income and start paying on them. So those are considered deferred payments. And on a credit report, it will show up as a deferred loan. So it'll show up on there saying deferred so that you know it's something different than a regular payment, right? So then the third one is your repayment of your private loans. And the fourth one is repayment plans of your federal loans. So the difference between a regular payment and then a repayment plan is where you weren't making payments, and then you work out with those loan companies a repayment plan of how you're going to pay off that debt. So it's not the original agreement of when you got the loan out. Now, for payments, there are 3 different types of payments, okay? So when you have student loans, there's one of 3 ways that you are going to have your payment looked at. The first is amortized, meaning fully amortized loan. When you get the loan, they say, this is the amount that you have to pay every single month, and it allows you to pay off the loan in the life of the loan, equal payments, etc. So that is a fully amortized loan payment. The second one is income-based. Now, this is the majority of Americans. A majority of Americans are on an income-based repayment plan for student loans. And what that means is that they look at how much you make, and then that determines the amount that you are paying for your student loan payment. And then the third is deferment. So whether you're at $0 right now and it's deferred and then you're going to be making payments, or you're already outside of your deferment and you're making those deferred payment agreement payments towards the loan. So those are the 3 different types, okay? So next, we're gonna get into the 4 main types of loans. So just to put them out there before we get into them, you have FHA, you have VA, you have USDA or RD, rural development, or you have conventional loans. So those are the 4 main types of loans that you're going to be looking at when going to purchase a home. All 4 of them are looked at differently with student loans. And so this is why I want to give you that information so that you understand how student loans are going to affect you based on the type of loan you're looking to get, or that you can qualify for. Because sometimes you might come and say, well, I want a conventional loan, but if you have a low credit score, that's really going to affect you negatively. And so you might have to look at an FHA loan rather than a conventional loan. And a lot of times people have, for some reason, this negative stigma of FHA loans. I think that comes from a while back, because they really are a great loan option, especially if you're not somebody sitting out there, with 800 credit score and $50,000 in the bank for a down payment. FHA is an awesome way to go, but that's a whole nother subject. So let's talk about FHA loans with student loan debt. So if you are making, so remember, we have those 4 different ways of payments, right? Either you're just making your regular payments you agreed to when you got the loan, it's a deferred payment, or it's a repayment plan of private or federal. So if you are just making those regular payments, when you come to your loan officer and they're looking at your debt to income ratio, you are then, how they're going to look at that is either the greater of either 1% of your student loan debt, to the total loan amount for that loan, they're going to take 1% of that, or whatever your actual payment is. So it's the greater of the 2. So the example I wrote down to give you is, if you have a $20,000 loan, let's say your monthly payment is $150, okay? But 1% of that $20,000 loan is $200. We have to take the $200, not your $150 payment. And the reason, and this is the whole reason I wanted this to be the topic of today, is recently over the past month, I've had quite a few people who have $0 as their monthly payment on a loan. And so they come to me and they're like, well, Kelly, why is this counting towards me? Because I've got $0. This loan is $0 paying, right? The problem is we can't look at the $0, because the reality is, over the 30 years that you have your mortgage, obviously you can go 15, but let's just say 30 for it, if you have that payment at zero, that payment is not going to be at zero for the whole life of the loan. So we have to factor in that 1% towards what your payment would be when that comes due and you have that mortgage sitting there. So for FHA, again, your regular payment, we have to take the greater of either 1% of that total loan amount or whatever your payment is. So if your payment's more, so that 1% on 20,000 is 200. If you're making 225, then the 225 is already factored into it. But if the payment is less than that, then that's when we have to take 1% of that loan amount. And I think that's the most important thing I want people to take from this and understand is that so often I hear I've got $0 that I pay. Why is it counting towards my debt? And the answer is because we have to. It's just one of those requirements for your student loan debt. So with deferred payments on an FHA loan, it's the same thing. It's either the greater of either 1% of what your total loan amount is or whatever that deferred payment is going to be. Whichever number is greater, that's what we take. Now with your repayment plans and for your federal and your private, those are different. Those we just have to take what your max mortgage, your regular payment would be on that loan. We can't go off smaller amounts. So for the repayment plans, it's what that payment plan states would be the payment. Now the only time with FHA we can do less than the 1% for that loan is if it's a fully amortized payment. So remember how we talked at the beginning about the 3 different types of payments? If you are making a fully amortized payment on the loan and it happens to be less than 1% of the loan, we can count that amount. The difference is that you would need to get the documentation from the company you got your loan from stating that the payment you're making is the fully amortized payment. So that's FHA. So moving on to VA loans. So VA loans are veteran loans. So not, again, getting into what all these different types of loans mean, but just letting you know the different ones we have and how it works for your student loans. So if you are making that regular payment on a student loan and you are applying for a VA loan, what we do is we take 5% of your total loan amount, we divide it by 12, and that gives us what the monthly payment would be, right? Now, if that payment is greater than what is reported on the credit bureau, then we take the payment as the amount. If that 5% divided by 12 is less than what's on the credit bureau, then we have to take what the credit bureau states is the payment towards your debt to income ratio. Okay? So with deferred payments for veterans, it's a little bit different. So where FHA loans, it was the same whether it was deferred or not with that. With the VA loans, it's different. So with deferred payments, if your loan deferment, your payments don't start until outside of 12 months from when your loan closes, then we don't have to count the loan towards your debt to income ratio. So again, let's say you are getting a loan and the loan's going to close in January. If you have a zero payment because your loan is deferred right now, and that loan is not going to come due to start making payments until February of the following year, if it's outside of that 12 months, that loan amount does not have to be counted towards your debt to income. Now, if it is within the 12 months that it's going to start back up from the time you close to 12 months out, if it's going to start back up during that time, then we take that 5% divided by 12, and then whatever that number is, that's what we have to count. So the example I wrote down for you is that if you have that $20,000 loan and you're applying for a student loan and you're applying for a VA loan, then what we do is we take that $20,000, 5% of that is $1,000. We divide it by 12, and the amount that we would count towards your debt to income ratio for your mortgage would be $83.33. So that's how that works. Now for repayment of the private and federal, we just have to use what your repayment plan amount is, okay? So for USDA and rural, and again, that'll be another video to talk about what that type of loan is, but for USDA and RD loans, rural development loans, your payment, if you're making those regular payments on the loan, is 1% of the loan balance. And again, the only time we can take less than the 1% of your loan balance is when you have a fully amortized payment, and that payment then is proven, and a letter from the company that you have the loan says that it's a fully amortized payment. So that's the only time. Otherwise, USDA is just 1% across the board. Same with deferred payment, and same with the private and federal repayment plans. It's all 1% of the loan amount for USDA. Now, the final one is conventional loans. So with conventional loans, you go either Fannie Mae or Freddie Mac. Okay, so with Fannie Mae, we use the payment stated on your credit report. So if that number is $50, then we use the $50 for your credit. If there is no payment listed, meaning if right now your payment for your student loans is $0, then we have to take 0.5% of the total loan amount and count it towards your debt to income ratio. If your payment for Freddie, if you're going Freddie Mac for your conventional, if your payment is greater than $0, we use whatever the payment amount is. If the payment is equal to $0, then again, we use the 0.5 balance. One correction. With the Fannie Mae, not Freddie Mac, so with Fannie Mae, we either use the regular payment, or if it's $0, then we use 1% of the loan balance. If you're going Freddie Mac, then we use the 0.5, okay? So, with that being said, that is everything I wanted to cover today. But the most important thing to remember is that your student loan debt affects you differently than your car payment, your credit card, etc. So be aware of the difference. If you're just jumping on middle of the video, go back to the beginning where I cover that. It's important to remember that your student loans are not going to count as such a high percent of debt to income, but they can't count as $0. So that's the only thing that is super important to remember, because it's the most common question I get, because so many people have their loans in forbearance or deferred payments. It doesn't matter if you're not paying on it. We still have to count a percentage of that student loan debt towards your debt to income ratio. So I hope you guys found that helpful information. You can always reach out to me anytime. If you're watching this and you have questions, I encourage you to post the questions in the comment section, because that way I can go on, answer them, other people can see it. Next week topic, I had somebody request that I do a video to discuss what main documents you need when you're getting ready to call a lender and get pre-approved. I always suggest give me a call. I'd love to be your lender. If you're an agent, I'd love to work with you with your clients. I work 7 days a week, 8 a.m. to 10 p.m., and I'm here for anything you or your clients need. If you're somebody interested in purchasing a home, please don't hesitate to reach out. And my website is kellyannhomeloans.com. That is kellyannhomeloans.com. Thank you so much for your time. Thanks for watching, and I'll see you guys next week. Bye.